In this video, we're going to wrap up the worksheet to chapter 17. So let's go. The company's net income after tax was $400,000 for its most recent year. The company's income statement included income tax expense of $140,000 and interest expense of $60,000. At the beginning of the year, the company's stockholders' equity was $1.9 million. At the end of the year, it was $2.1 million. So, number 12, what's the times interest earned for the company? Now, we have learned that times interest earned just basically tells you how many more times much money you earned than the interest you paid. Hopefully, it's a lot. So we know that it's the income before interest and taxes divided by the interest expense. So let's see what we have here. We know that the income after tax was $400,000. So that's the bottom line. Well, we had to deduct some things to get to there, and what we deducted was our interest expense and our income tax expense, which are related to each other. So if we'd like income before that, we have to add them back. So to our 400, we're going to add back our income tax expense of $140 and our interest expense of $60. So 400 plus 200 is 600 is our income before interest and taxes. Okay. We're going to divide that by our interest expense. Our interest expense was, it's hiding here someplace, $60,000. So 600,000 divided by 60 says we earned 10 times as much as we spent on interest. Is that good or bad? Well, this is what? It's better than 20 and not as good as 5, but it depends on the industry, doesn't it? And it depends on the company and its capital structure. Lots goes into that, and if you take a finance course later on, you'll probably spend some good time learning about that. Number 13, what is the after-tax return on stockholders' equity for the year? Okay, well, what's our after-tax return? $400,000, huh? And we're going to divide that by our equity. We're going to divide it by our average equity, and we know how to take averages. The equity started at $1.9 million. It ended at $2.1 million, and we're going to divide it by 2. So $1.9 million divided by $2 million is $2 million. So $400,000 divided by $2 million is, I believe, a return of 25%. 25% is a pretty good return, I think, huh? And lastly, debt to equity ratio is going to be total liabilities divided by total stockholders' equity. By total stockholders' equity. There you have it.